Welcome.
Thank you. Thank you for your service to our children, and thank you for your service to your members, and thank you for having us here today. We're excited to be here. We understand you want to move it along, and you see we have 10 state retirement funds as clients, so we're used to that. We're good at it, and we will do that.
And just in terms of process, we've allowed committee members to raise questions throughout your presentation. So you might get interrupted during your presentation, so committee members can ask questions at that time.
That's great. And I'm Barry Dennis. I was one of the founders of SIS. And when we set out, we were going to work with big clients, and we've stuck to that. And that's important because I think if you bring on a lot of smaller clients, they dilute the resources of the firm, and they don't pay their freight. We want all our clients to contribute equally to our research effort and the wellness of our firm. We're small. We're small by design. I think growth is anathema to good consulting. It promotes cookie-cutter approaches. Everything we do is customized for each client, and it promotes this process of a senior client handing down a relationship to a less senior consultant, and that neither of those are good for you. We're stable. That tells or should tell you two things. One, we treat our clients well. Two, we treat our people well. And I want those two things on my tombstone. 4, no conflicts of interest. We founded the firm in 1994 with that principle, Mike Beasley and I, and we've stuck to it. When we did it in 94, we were about the first ones to do it. Today, you have a lot of good choices that make that claim. What's different about today is most of those other choices that make that claim have gotten into what's called the outsourced CIO business, and we're staying out of that. And I think, and I could go into it in detail, that it presents a whole raft of serious conflicts that most people don't quite understand. The other principle we found at our firm was basically what we call today big data. We saw a lot of data out there that was available in good quality at a fairly low price. And if you look back in the appendix, you'll see there's 16 vendors of data that we buy data from. It's good data, and we don't have to bear the expense of maintenance of data and manager history, et cetera. We can buy that. Next, I'll introduce people on my left and right. Deborah Gallegos on my left, John Meyer on my right. Deborah and John would be your day-to-day consulting team. And you can see they both have plenty of capacity to devote a lot of time. They each have 2 primary relationships and 1 and 2 backup relationships. My role would be as sort of the senior advisor. I'd be there when you need me or want me, and I would help with idea generation. You'll see we all have a lot of experience. John and I were founding employees. Deborah joined us 8 years ago. Previously to helping start SIS, John was a project manager at Barra. They provide risk analytics to more money managers and plan sponsors than anybody else. They're the preferred vendor.
Before you go on, Mr. Dennis, we have a question from a board member, Mr. Utterman.
One of the reasons for asking questions early is to try and get you into the substance of the issues we're dealing with. So we have a very large commitment to global equity, and within that commitment to indexing. I'd like to know your thoughts about both in terms of size of allocation and the philosophy of indexing. Second, your thoughts about diversification of risk away from that large commitment to equity, where you see asset classes that are non-correlated, and your philosophy or approach to the non-correlated assets, expense, illiquidity, et cetera.
The very back page has the asset allocation targets of all of our public fund clients. And 50% in U.S. and non-U.S. equities. So it's not that far off from your allocation. I believe you're at 55. And we're comfortable with that. I'm going to come back to that question later. In terms of indexing, I think I've been doing this for over 30 years, and I can't tell you how many times I've gotten the question, should we be passive or active? And my answer is yes. You should be both. But someone of your size has to be a lot more passive than they are active. It's just a law of large number. You'd have to hire so many managers that with your active portion, you'd be creating an expensive index fund. And we don't like that. Fees are very important. Cost control is very important to us. Let me come back to the asset allocation question. I think that if we were in normal times, we would be suggesting to you a slightly different approach. And that would be what's sort of become known as risk parity, or the idea of levering up your low-risk assets, your bonds, your TIPS, basically. We don't think that's a good strategy today because of what our Federal Reserve Bank is doing. Interest rates are too low, and they're basically charging you somewhere from 1.5% to 2% in a hidden tax. And we don't want you to pay that tax today. When things normalize, and what I call normal is money market returns are above inflation, bond returns are 1.5 to 2.5 above cash returns, and equity expectations, or the equity risk premium, are 3 to 3.5% above bonds. When things get into a normal situation like that, we would be talking to you about risk parity. And we think that's a way to achieve returns that are similar to a 55, 60% equity portfolio with lower downside risk.
And today?
Today, I do exactly what you're doing. I think the stock market is, the earnings yield on the stock market is very attractive. And it may not be great, it may not even be positive, but it's probably going to be better than bond returns. Okay, I was saying John, project manager at Barra, he's a quant, but he can speak English too. Deborah's last job was as CIO of the New York City Retirement System, a fund of 5 funds that's almost as large as yours. So she's sat in Chris's shoes. And I would say that away from business, Deborah and I both sit on the finance committee and the board of the Stern Grove Festival in San Francisco. Deborah and I are both on the finance committee of the City College of San Francisco, so we sit in your shoes in those capacities. John is the executive director of the plan sponsor and consultant committee of the GIPS standards. That's Global Investment Performance Standards. They're the ones that set the rules to make sure that money managers don't lie to you when they present their returns. So we think it's important to give back to the community. And I think if you look at the clients that have been with us for a long time, I've worked for the state of Wisconsin for 17 years. I've been their consultant. John, Oregon for 10 years. I actually was Deborah's consultant back in the days. I've been at New York City for 17 years, and Alameda County has been a client for 13 years. So those that have been with us a long time have done well. This is the point of the presentation. I turned lemon into lemonade. We got some bad news from Oregon last week, and it's only fair I tell you. After a long period of time, they've decided to go in a different direction. It's not because we didn't do a good job, obviously. There's a new CIO there, and he thinks to stay at the top, they need a new set of eyes, and that's the business. But I thought it's only fair that you know that today. So that's all we are going to say about the firm. We'll move right into category A.
So, SIS has been involved in the development, review, and maintenance of investment policy statements since our founding in 1994. We believe that an investment policy statement should be clearly written, concise, a concise working document that fiduciaries know intimately and understand thoroughly. So because of that, It is one of the first things that we would do if we were to be hired for Category A, is to really dig into the investment policy statement as it exists and work with staff and the board in understanding what the objectives and beliefs are and making recommendations where appropriate and if necessary.
Before you continue, Ms. Gallegos, Ms. Hendricks has a question.
Could I just jump in, because that's actually something I'm curious about, and I just wondered if you could comment a little bit on our investment policy at CalSTRS, and if there's anything unique or interesting that strikes you about our policy, or any critique, or what do you think of our investment policy, and what do you think are its strengths and its weaknesses, or what stands out to you?
So I was looking through the allocation, and I was curious about the hedge funds. It looks like the allocation to hedge funds is fairly low, if existent at all. So I would probably explore that a little bit and understand what the beliefs were behind the allocation to hedge funds. We at SIS were hesitant to recommend hedge funds to our clients until after the dislocation in the market. We believe that if we go back to page 6, new investment types are the result usually of a dislocation in the market. Hedge funds existed, obviously, but as far as being an institutional investment for clients, they really weren't something we were willing to recommend to clients until the dislocation had sort of separated those that were investment institutional oriented and those which were not. So that would be one of the comments I would have on your investment policy, and wanting to explore that with you and what's really behind that. I think it's important for us as co-fiduciaries, and we do serve as co-fiduciaries to all of our clients, to understand what your objectives are behind each decision that you make and each item in your investment policy statement.
I think what you do very well in the policy is you combine, what you do very well in your policy, and I'm an English major, so I look at this stuff, but you combine the elements of government seamlessly with the elements of investment. And I think that's the sign of a very well-written policy.
Can you expand, like, what's an example, or how do you see that happening in our policy, or?
The position on ESG would be a good example. It makes it clear what you're trying to do while maintaining your fiduciary role.
Good.
So we've touched on, I'll just go back to quickly to page 6, some of the examples that we've seen of new asset types that were the result of a market dislocation are opportunistic fixed income, modified total risk parity, modified for the leverage incurred, and commodity currencies. And so those are the things that we would look for in approaching you with ideas of new asset types to recommend. We help our clients in quantifying the risk tolerance. We have a proprietary methodology that we use that we can go into in more detail if you'd like us to discuss that. And we believe another key element in your investment policy statement is the rebalancing rules. The rebalancing rules are really, rebalancing is primarily a trade-off between cost and risk, so it's very important because we do not have a formula for market timing. We really need to develop what those rules are so that the plan knows when that cost benefit situation exists in your favor. I'll turn to page 7, which is the manager research section. So as part of the mandate A, if we were to win, we would work with you on manager research. I'm going to start from the very bottom, which is our flexible manager search process. We understand that staff runs the search process with consultant input. That is something that many of our clients do. We usually run a dual track with most of our clients where we will search our database, the client will search their database, we'll come together, we'll discuss what the lists look like, where the overlaps are, what the differences are. So we're very used to working alongside staff in coming up with names that should be considered, or providing our input where staff has their own list of names to be considered. We believe, going back to the issue of democratization of data, we believe that manager data is a commodity. There are many databases out there. Everyone has access to them. All managers put their data in them. What our value added is the ability to interpret what the manager is telling us. And that comes with experience. Our long history with managers is an invaluable resource. All the professionals at SIS participate in the manager research process for that reason. Barry's history of being in the business for 30 years and seeing portfolio managers who have also been in the business for 30 years is critical. I've been doing this for 23 years. I started out as a manager research consultant at another firm 23 years ago, have seen these and followed these firms for 23 years. That history and knowledge of these firms and how portfolio managers have evolved, styles have evolved is critical. So we don't believe that you can get a whole lot from just looking at the data on the databases. Therefore, we just access all the databases. We have access to all of them out there. What's critical is meeting with those managers and interpreting what they are telling us and understanding what's in their portfolio.
Before you continue, Ms. Gallegos, Mr. Rosenstiel has a question.
Thank you. Yeah. Getting back to the question that Sharon asked about our investment policy and your thoughts on it, and you mentioned the fact that we really don't have an allocation to hedge funds. I was wondering if you would comment on our allocation to fixed income, because looking at the book you passed out on page 20, the fixed income allocation of all of your plans that you work with range from a low of 20 to a high of, looks like 56%.
And yours is about 17%? 16%. Okay.
I would say that's the target. Now, each one of these has a range, and in March of 2012, we advised all our clients to go to the bottom of their range. And as we've been going through the asset liability cycle with clients, the fixed income allocations have been going down because our long-term outlook for fixed income is not very good. I think 17 is a good number. You can't jettison fixed income. Fixed income will be your anchor if we go into a deflationary spin. It'll be your anchor if we have some other bomb go off in the economy, and you have to keep some of it. And I think right about where you are today is the sweet spot.
In doing what with it? I mean, in just shortening duration, or are we gonna, go for credit risk and private loans, or what do you do with it?
Yes.
To both make it, if possible, a hedge against risk, and at the same time recognize that we have a long-term expectation of 7.5% return.
I mean, we just went through a large effort with one of my corporate clients, where that's really what they were worried about. They said, okay, and they had a bigger allocation to fixed income, but they still wanted the anchor, but they didn't want the interest rate exposure. They didn't want they didn't want too much credit exposure, which would be a proxy for equity exposure. So we went through an entire effort of trying to find managers and strategies that would do this for them. And we ended up taking about 40% of their fixed income portfolio, which was in typical core bonds, and putting it into things that were not typical core bonds. There were some hedge funds, there were some direct lending type things, and leveraged loans and things like that. So we recognize that that's not a place where you want to put a lot of money. It's, there's risks there. Low rates, well, your returns going forward are not going to be very, very, very high. So looking for alternatives, but like Barry says, you can't just say, well, I'm going to put 100% into risky assets, because there are, something could go wrong and you need that anchor.
But I do think, and this goes with the new ideas, that when we look today at what's available, there's one asset type that stands out as having higher expected returns from here today than it's produced in the past. That definition is pretty key. And that is direct lending, primarily in Europe. The banks have exited the business. There's fat premiums, they're over LIBOR. They're floating rate notes, so you don't have the duration exposure, the interest rate exposure. And you get origination fees of 4 or 5%. That's a really sweet spot today. And I don't know how much money a fund like yours could put into a class like that. It's probably estimated to be a $4 trillion market, but it is fairly significant. And that would be our idea today.
Mr. Arterman?
It sort of follows Paul's line of questioning, but it's also one we've just been asking everybody else. If you look at over the past 3 or 4 years, look at your universe of clients, can you give an example of an idea or a decision you led that worked really well, created real alpha, and one where it didn't work well at all and there was a significant lesson to learn?
I think the big home run is going deep into opportunistic credit in early 2009. That was shooting fish in a barrel, and it's really worked. Those programs have produced returns of approximately 20% since then for fixed income type instruments. And they included a big slug of PPIP allocation. They included distressed. They included more high yield, more bank loans. That's probably the best example that we were able to work in significant size. You know, the one that worked okay but blew up in May, June is the risk parity idea. And we do like risk parity. We like the idea of going slow, but we have one client that has basically 4% of their assets in there, a large public fund. And with the temper tantrum, that blew up May and June. But it's come back fairly well since, and we still think it's a very viable strategy. But as I said, I'd like to see things normalized before we'd go much further. And I'm talking 10, 20, 30, 40%. It's that attractive of a strategy.
Okay, that's a good answer.
Mr. McGuire?
Thank you. I have, I guess, 2 related questions. The first is, the RFP was kind of split into 2 schedules of services, and I would like your general reaction as to whether that makes sense and why. And if it does end up being split, which of those 2 schedules of services do you feel you can add the most value in providing to CalSTRS?
I was going to say you stole my thunder, because that was like my next page was what we're talking about, and exactly those questions is first of all, the splitting that you've done, the benchmark and asset allocation approach or assignment is the exact assignment that we've been doing for SWIB since the start, 16 years. So we're very comfortable in that role, and we've done it for a long time. We actually, as you can see from the results, it's worked well for them. We have no problems with that approach. I think it works well because you do get a variety of opinions. So you have somebody looking at strategy and somebody benchmarking what somebody else is actually picking. So it creates a tension, shall we say, where the consultant is not trying to justify and measure their own picks. So it creates that's a nice disaggregation of who picks it and then who monitors it, beyond just the staff doing that as well. Okay.
Answer to your second question is category B. That's what we think we are best at, and we could clearly add more value in that area.
And why? You said, okay.
And why? John will get into the why.
Okay. There's a nice segue into here's the other part for the asset allocation and benchmarks. As you say, we've been doing, like I said, we've been doing this for SWIB. I think it's a nice approach because when you're selecting benchmarks, you're not only looking at, well, what are the return characteristics I'm expecting, but what are also the risk characteristics, and putting those together with the asset allocation is something we have done since the get-go. And this, I could say asset allocation, asset liability, and benchmarking is your primary risk management tool. You know, you're setting your long-term targets and implementing those long-term targets through these two facilities. As I said, we've done this a long time. We've been at the forefront of doing special benchmarks for private equity. We've also looked at the mismatch currently in real estate and how that's improving. So since we've been active in this space for a long time, we think we're particularly well qualified for that. Page 10, asset liability.
Before you go on,
Okay.
Mr. Rosen still has a question.
Actually, go finish this, because my question is going to be related, I
Okay.
think, to how you.
Asset allocation, asset liability, obviously, you know, the name of the firm is strategic. So we believe that we spend most of our time focusing on strategic issues. We think that, you know, obviously the capital market expectations are key to that process. There's also the modeling. We spend a lot of time modeling assets, modeling liabilities, putting them together, trying to come up with what could happen. Now, a lot of this is this becomes a data analysis, information analysis. As you do all this modeling and analysis, it's just you can get information overload. So the idea within the consulting is to take all this information and analysis and actually make rational decisions of why am I doing this or why am I doing that. And that's part of the process that we bring as consultants is communication of those characteristics. What are you worried about? What are you trying to achieve? What do you want to avoid? Put all those together to derive an investment policy. Now, we spend a lot of time on our expectations. We use vast amounts of data. We don't think we're perfect at this, far from it. However, we use the markets tell us a lot of information, and we use that. Things like inflation and returns to bonds. You know, those are priced effectively daily, so we use those long-term expectations. There are some characteristics. We believe in mean reversion within kind of long-term real return corridors. So if an asset class has done well, we think going forward it'll do a little bit less. Pretty simple. We don't know when, but we think over the long term, if like bonds have been doing great for the last 30 years, well, when yields are at 2.5, well, you can't expect 7 going forward. And it's a process. We do this every 6 months. There's a process we go through. We end up with judgment at the end of how the final expectations come out. And then with that process that we've used, we have added as the expectations change over time, we've added a little bit of value over what I'd call just a buy and hold static allocation. We've added 30 to 60 basis points depending on the riskiness of the mix.
Yeah, and that was my question is because you wrote that in your proposal as well, that over static allocations, your process gets some increment. So is that saying that for any asset allocation, if we just stuck with that asset allocation, we would get X, but your process would take that very same asset allocation and get us 30 to 60 basis points per year better returns?
Correct. By slight, it'd be slight tilts based on how have the expectations changed from what they were 6 months ago.
How do you do? I mean, how do you know what the market is going to do so that you're and gosh, that's great. I mean, why doesn't everybody use you if that's the case?
Now, it's not just, let's say you start out 60-40, we keep you 60-40. And I don't want to get too technical, but that 60-40 has a place on the efficient frontier. And what we want to do is compare you as if you maintain that placeholder on the efficient frontier. That's what we're comparing the new portfolios to. It's not just a static portfolio. I want to be clear about that. Why does it work? Mean reversion.
Right.
Prices tend to revert to their long-term means. So as John said, if something has done very well recently and we had an 8% return on it, we'll downgrade it the next time to 7.8, 7.7. Something's done very poorly, we'll upgrade it. And that's why it works. Markets over the long term do tend to mean revert.
Mr. McGuire?
John, I think I heard you say that you review asset allocation internally within your firm like every 6 months. Do you recommend your clients do that more frequently than once every 3 years?
Well, it's more of a, I would say the full asset liability study would be the longer term. But I mean, looking at an asset allocation and say, well, expectations have changed. And am I still efficient? Does this still make sense? Or maybe should I, like I said, you've had an equity run-up and bond yields going up. Is now a time, well, maybe if we were to look at the same, kind of use the same parameters that we used when we set the initial allocation, what would it look like? Doesn't mean you'd actually change, but maybe it says, does it imply something significantly, or even a significant move from where you currently are?
So the typical client has an asset liability study every 3 years, and we look at the asset side only every year.
Mr. Lawson?
Thank you. Can you talk a little bit about the diversity of your organization as a whole and this and the team that would be serving us? I mean, it's in the context of the fact that this fund is the membership is extremely diverse, the executive team and staff, both on the administrative side and the investment side, is very diverse. And it's very important to this board that we take account of the diversity of the people that we hire. Can you address those issues?
Sure, I'll address it because that's an important issue to me as well. And it was something that I was looking at when I joined SIS. So this is your team here. John and I would be your day-to-day contact. I'm Latina, I'm Hispanic, so 50%. We are a small organization. We don't hire very often. We're 30, I believe we're 30 people currently. And we've hired, I'd say, 3 people in the last 2 years, 3 or 4 people in the last 2 years, and that's a lot for us. The last 3 hires, and I can't remember who the 4th one is, but the last 3 hires have all been minority. I think I was the last fairly senior hire, and I'm a minority. So we don't hire very often. When we do, it is something that we do consider important.
So 15 of the 31 employees would be considered non-white.
Thank you.
And, modeling, I'll just go through this real quickly. We like everybody else, we do, there's a lot of modeling that we do. If you look at the theory of models, they say certain things. We recognize that those don't hold true in the marketplace, so we make adjustments. Things like, fat tails, higher correlations under stress, look at probabilities, extreme probabilities of events. We look at historical events to say what would happen, if we went through this again. So when we look at risks and outcomes, we look at not only the stochastic, the broad variety of things that we don't know could happen, about what they specifically are, but we also like, well, what happens if this happens? What's the impact on the fund? To get, and in many cases, it's a comparison of mixes, not just one. So you can look at, here's a set of 5 mixes. If we went through 2008 again, what's the returns? Okay. Now, it doesn't matter if you're 80% equity or 20% equity, you'd have bad returns. So sometimes the outcomes are still pretty bad. But we spend a lot of time on making sure that the results that we present, the analysis we present, offers you a perspective on the risks that your portfolio is taking.
Now, one thing everybody else can't say is our asset liability model was developed by a gentleman who won the Medal of earned the Medal of Freedom from President Ford for putting the Viking probe on Mars. So we have a true rocket scientist behind our model. I don't think the others can say that.
Okay, and I'm going to finish with performance measurement and reporting. And I think, our idea is ethically based industry standards interpreted by experienced professionals. And that's really what we're trying to do. My volunteer work with the CFA Institute has been with the CIPM, which is an affiliation of the CFA Institute, to create a certificate for performance measurement professionals. I was on their advisory committee for 8 years, starting from the start of the program. I was its first chairman. And then I've recently gone from that to be, like I said, Barry talked about it, is on the GIPS executive committee. So it's in our, I'd say in our DNA to make sure that the results that could get presented are correct. They tell you what you need to know, and you can use them to manage the portfolio going forward. Performance measurement is backward looking, but it's backwards. So it's already happened. There's nothing you can do about it. So what the whole idea is to use that information to see what does it tell us that we should do differently going forward. And we have tools. One of the things we do, we outsource the tools so that we don't have to be a large organization. This again, the democratization. Can't even say it. Of data and analysis, we outsource things that when you have larger organizations putting a lot of resources to it, and we take advantage of those resources.
Let me add just briefly that we'd go beyond what you asked for in the RFP and give your access to real-time our investment measurement platform, and they would have daily access to that beyond the 2 reports per year that you request at no additional cost.
Are there any other questions from committee members? Seeing none, I'll ask one. Mr. Dennis, you referenced our ESG policy briefly earlier in your comments. Could you elaborate on your firm's belief around ESG policies and what roles they should play and can play in a large institutional investor's portfolio, not only today but going
I'll let
forward?
Deborah start out and I'll finish.
So, let me just go back to, this is something that we did acknowledge in your investment policy. And what we've seen is historically of the companies that sell to consumers, those with strong ESG principles tend to do better than those that don't. And consumer-oriented companies tend to do better than those that are B2B or business-oriented. So focusing your effort there, I think, is a key element. And I'll let Barry follow up with his comments on that.
I think it's a good thing when you can do well by doing good. And we support that 100%. I think that as fiduciaries and with a statute that talks about exclusive benefit, that you have to be able to document and justify your decisions. So I think there's a lot of study in the area left to be done, but I think you're on the right track, and I think it holds a lot of promise.
Thank you. So you have 5, if there are no other questions, you have 5 minutes for closing comments or statements if you'd like to use that 5 minutes.
Okay, well, we gave it our best shot, but if I could summarize. Now, if you believe that advice from a consultant shouldn't be tainted by any conflicts of interest, and if you believe that experience, which you have here, understanding of theory, and being able to produce the empirical evidence to support the recommendations is important. And if you believe that stability is important, stability of the people you're working with and stability of the firm, if you think that's critical to a good long-term relationship, and if you think having a window into what other clear-thinking large funds are doing, then I think our firm deserves strong consideration. And this I don't think, this I know, that we really want to work with you, and we would very much appreciate your business.
Thank you very much. Thank you.
Thank you so much.
Thank you.
Thank you.